In this video I'm going to talk about trading candlesticks, and I'm going to show you how they can be useful in putting together bits of the jigsaw in interpreting price action. I'm going to explain how candlesticks form, what they represent, how you can use them to judge bullish and bearish pressure in the market, and how you can use them to trigger trades and ultimately make money from the market. There's going to be a lot of information in this video, and of course you can watch it as many times as you like until you've got it all stored and ready to use. So here in front of us we've got the 1 minute chart on the DAX, the German stock index. Now I don't normally trade the 1 minute chart, but it is possible to trade it, and for this video it's going to give us plenty of action for us to discuss. So as you can see, I've got candlesticks on the chart and they're representing the price action. Each candlestick represents key elements of price action in a certain time frame, and in this case they're 1 minute time frames. The candlesticks therefore are 1 minute price bars. You can see on the chart, you can see a variety of candlesticks, some green bullish ones, some red bearish ones, and some that look less like candlesticks and more like crosses with no bodies or very small bodies. And this is the pre-market action on the DAX, so the price bars are smaller than they will be once the market opens in a few minutes' time. I'm in the UK and the main market opens at 8 AM UK time or 9 AM Central European time. You can see a big green spike at 7 AM, and this is where the DAX futures market opened. The first key point here is that context is really important in terms of the individual candlesticks, and what I mean by context is where do the individual candlesticks appear in terms of overall price action? Are they somewhere in the middle of a series of other candlesticks, or are they at the top or the bottom of a range of prices? And how do we actually assess that? Well, we have a look at what's been happening on the left of the chart. So let's have a look then at the trading over the last hour or so, because it can often give us clues as to what to expect during the opening stages of market trading. First of all, has the market been trending or in a trading range? Looking at that, what do you think? Well, to me, it largely looks like it's been in a range, and it may be part of an upward trend, but the latest trading has definitely taken place within a fairly tight range of prices. We can actually place a line at the top of the range, the top of the 7 AM spike, and also we can place a line at the bottom of the range. These two lines incorporate all of the prices in the time since 7 AM. Prices have been fluctuating in between these two lines and within this range. When the market opens, we'll be watching to see how price reacts when it reaches these trading range boundaries. Will it break out upwards or downwards, or will price rebound off those boundaries? It's a fairly broad range. There are nearly 50 points between the top and the bottom, so it'd be possible to trade within the range if price decides that it's going to stay within there. Average 1 minute price bars on the DAX are 10 to 15 points high, so when the market opens you can expect to see the price action warm up a bit. You can see that the lows have actually been getting higher, and so have the highs over the last half an hour or so. Price is moving steadily away from the bottom of the range. So let's have a look at how a candlestick is made up. And to do that, we're going to have a look at the big bullish spike at 7 AM, the biggest candle on the chart so far. So the candle opened here and it closed here. And this makes up the body of the candle. In this case, the price closed above the open, so the candle body is green. The highest price in the candle is here at the top of the spike, and the lowest price is here at the bottom of the spike. It looks like price went down when the candle opened and then peaked at the top before coming back to the point at which the candle closed. We can't tell from what we can see that it happened in this order. However, this is probably what happened. So each candle shows the open price, the close price, the high and the low. And this is one reason why they're useful. So what does this tell us about price action within this candle? Well, it tells us that price went up. It tells us that the bulls faced serious competition from the bears at the highest prices, and in the end, the bears probably edged it as the candle actually closed below its midpoint. When the candle was at its highest point, the bulls were in control, but they lost control and the bears pushed the price back down below the midpoint. So the bar ended with the bears on top. Each bar tells a tale like this, and as I said, context is important. So if this bar was in the middle of a series of bars of similar size, then it might not mean anything. This is a special bar because it's the 7 a.m. bar, and we often see price spikes at about 7 and 8 o'clock as the market tests higher and lower prices to see where the appetite of the market participants is. Is the appetite for higher or lower prices? And I'd say that given that the bears took control at the top of the bar, then if prices were to rise up there again, there'll be bears looking to sell. Let's have a look at another bar then, another candlestick, so that you start to get the gist of what's happening here. So fairly close to the 7 a.m. bar, we've got a big strong bearish red bar here. So let's have a look at this. As you can see, the price entered the time period almost at the top of the bar, tiny little wick on the top there, and the price closed near the bottom of the bar. Okay, so obviously prices went down during this 1 minute time period and closed near the low. Therefore, we can conclude that this was a very bearish bar. Okay, so you can categorize candlesticks in lots of different ways, but one way to categorize them is to either say they're a trend bar or they're a trading range. Okay, so each candlestick represents a very small, on this chart, a very small period of time, and in themselves, the price action within that time frame is either trending or it's in a range. Okay, so a bar like this, where it opened on its high and closed on its low, it's a bearish trend candlestick. Okay, if it was the other way round and it opened on its low and closed on its high, then it would be a very bullish candlestick. Now, with this particular bar, it may just have been a continuation of the run down, the sell-off from the high of the spike. So nothing to get excited about. And as you can see, actually, the price just retraced slightly after this particular bar. And there is a very small tail on the bar. Okay, so if the bar closed exactly on its low, then you'd probably expect the bar to be followed by another red bearish bar. It didn't close exactly on its low, and it was also retracing from the top of the spike. So in actual fact, looking at this, the bears had control during that bar. It's right in the middle. Think about context again. It's right in the middle of the range of prices here, and therefore, did it mean anything? Not really. Okay, so that's a trend bar. So let's have a look at a range bar. Okay, so some of these bars on here, as you can see, have not got very large bodies at all, and some of the bodies are almost non-existent. Having a look at one here. So with this particular bar, you can see that it looks like a cross, and prices opened and closed at around about the same level, went up slightly, and it went down during the period as well. So it's got a high and a low, and the open and the close at about the same level, and this is called a Doji bar. And in this case, it just means that prices were in a range during the time frame of the bar, and they closed at the same level as the bar opened. Okay, so we'll go into more detail in all of these bars a little bit later in the program. However, just for this to get you warmed up with all of this and get you to start noticing the difference, I want you to start thinking of trend bars and trading range bars, trading range candles. Okay, and the Doji is a trading range candle. Right, so let's have a look at this in more detail. We're approaching 8 o'clock now. So it's 8 o'clock now, and you can see that the 8 o'clock candle is now forming. So it opened near its current high and it went down initially. Okay, so there's the 801 candle forming now, and you can see a big green bar forming here. So it's making highs at this point in time. So quite a lot of traders do trade the exact open, the 8 o'clock open, and it's a tricky time to actually trade. What I find is that price tests a high and a low of a trading range during the first couple of minutes of trading. So just like it did at 7 o'clock, it'll see whether people are attracted to higher prices or to lower prices, and this is what's happening at the moment. So you can see effectively the bar is now roughly where it was when it opened at 8 o'clock. Okay, and so I suppose just looking at this now, there's no real clue as to, from what's happened so far, as to whether prices were attracted higher or lower. So bear in mind again that actually we are pretty much in the middle, lower to middle side or end of the range that we identified at the beginning of the video. Price is sharply falling down to the bottom of the range at this point in time now. So this is a big red bear bar forming at this point in time. Okay, so just going back to the 801 candle now, just have a look at that one. That's an interesting shape of candle. So you can see that it's almost identical in shape to the 7 a.m. candle. Great long wick on the end of it. And this is what we call a pin bar. Okay, so pin bars they're useful as long as the context for them is right. So a pin bar is useful when it forms at an extreme. So if a pin bar was to form at the high of a range or the low of a range, then it could indicate that prices have been rejected from the extreme of that range, and therefore what might follow is a move to back within the range and towards the upper or the lower side of the range, the opposite side of the range. And as you can see in this particular instance, it was followed by a large bearish bar. There are lots of different participants at this point in time in the market, and they're all getting excited at this point in time. They're placing their opening trades. So you can take a lot of the price action at this point in time with a pinch of salt. Again, we're using a very short time frame here. It's a 1 minute time frame, and so you can expect lots of noise in the market during this particular time frame. Okay, so the 802 and the 803 candles are fairly interesting there, because the bottom of the two candles lines up nearly at the bottom of our trading range. Okay, also you can see that the 802 bar is red and the 803 bar is green. So we had a bearish move down and a bullish move up quite quickly, one following the other. And this particular pattern is called a pipe. Okay, so it's where you get one big bar going in one direction and then a big bar going in the opposite direction, almost retracing the whole of the move of the previous period. Okay, and when this type of candlestick, these two candlesticks form at an extreme, then you call them a pipe top or a pipe bottom, and they could signal a move in towards the middle of the range again and up towards the top of the range. So this is what we're going to be seeing whether the market does here. You can see that the 803 bar closed on its high. It was a bullish bar. It closed on its high. Very often but this particular, the 803 bar, actually opened at just above the low, or just above the close of the 802 bar. Very often these type of bars, they'll actually open just below the close of the previous bar, and in which case they may be titled in themselves, titled a piercing pattern. So at the moment we can see that price is just testing the boundaries of a smaller range, so the range from 750 roughly, the upper and the lower limits of that particular range. The bar that's forming at the moment is a bullish bar with a big tail, fairly big tail on the end of it, and it looks like the price is rejecting the lows of the pipe, so it didn't actually get to the low of the pipe, but it looks as though it's been rejected away from that. So when we see higher lows, then we can tell that the market is moving upwards. So we're getting higher highs at the moment and higher lows, so the market's moving upwards. So the first two bars, since 8 o'clock, the first two bars, first bar was a doji near enough, closing on its high. The second bar was a pin bar, closing on its low, but with a very, very small body. Most of the bars so far have been trend bars though. The last bar there at 806 was a range bar, so although it had a strong green body, it also has a wick on each end of it, which implies that the price was in a range for that particular period of time. So we can see that price is rising now to the top of the range that's existed since 702, and it's also significantly at the price of 10,250. So be interesting. Round numbers are important in trading. Lots of people use them for their orders, so people may have orders to go long or go short at 10,250. So the market often pushes up to that level and then starts retracing backwards, and sometimes it pushes through that particular level and tests to see what appetite there is at higher prices. So you can see that all of the prices on the chart so far have been below 10,250, and the last time it reached that level, it rejected back down below that level. Pushing up now to the high of the 7 o'clock candle, and therefore the top of our range. So what we're looking for at the top of the range is it going to break out and push out beyond the top of the range, or is it going to reject at the top of the range and start coming back down again? If we were looking to trade this range, so let's assume at this point in time, let's just assume that price does reject from the top of the range. If we were to look to trade this range, so we'd be at the top of the range and we'd be looking to trade back down to the bottom of the range, and therefore we'd be looking to effectively fade this initial move up to the top of the range. So if we were looking to do that, then if we got a massive long bearish bar that finished, let's say, in the middle of the range, then obviously with the bar finishing in the middle of the range, there wouldn't be much scope to trade price down from the middle to the bottom of the range. Wouldn't be a lot of scope there. So what we'd actually be looking for is we'd be looking for a fairly small bar at the top of the range. So if we got a fairly small bar, could be a doji bar or just a bar that's small in comparison to the other bars that closes at the top of the range. So either a pin bar, one with a big wick on the end sticking out at the top, ideally with a bearish body, but it doesn't necessarily have to have a bearish body. If it closes below its midpoint, then it's bearish anyway. So we'd be looking for some sort of reversal bar or a small bar at the top. And that, what we might be able to do then is to be able to take a trade down to hopefully to the bottom of the range. Interestingly, at this point in time, you can see that the chart price action since 8 o'clock is forming a channel. So it's a bullish channel. And you can run lines up the lower side of the channel, so that would be your trend line, and you can also run almost a parallel line up the top side of the channel as well, and price is staying at the moment within that channel. So if you were to trade, let's say you were to trade down, then down to the bottom of the range, then you'd be looking first of all for price to break the boundaries of that channel, and once it's broke the boundaries of the channel, then there's a change in price sentiment. The trend therefore will have been broken, and we'd be looking for a different type of price movement from then on. So price could either break these lines by moving to the downside below the lower channel line, or it could actually break above and to the higher side of the upper channel line. Either way, it would actually signal some kind of change. So let's see what happens. That last bar was it was a bullish bar because it had a green body to it, and it had a pin, if you can see, on the top. So it was almost a perfect pin bar, but it didn't really mean anything because it had price action to the left of it. So effectively, it just formed part of the same price action that had been forming previously. It was like a trading range bar essentially. Now you can see that price action's coming down away from, so it's broken now the trend line, the lower trend line, and so we'll wait and see what happens next. So it's moving down below now. We did get a couple of fairly small bars at the top of the range. Now this bar is actually significant in another way because it's called an inside bar, and inside bars actually indicate hesitation in the market, and you can see that now it's actually been followed by another inside bar, or almost another inside bar. So we'll be looking at this point in time to see whether or not price breaks above or below those two inside bars. Lots of traders will be waiting to see which way it goes, and very often traders will place their orders either above the inside bars or below the inside bars, and some traders will place orders in both directions. So if it goes up, they enter a long position. If it goes down, they enter a short position. And you can see now that it's actually broken below the inside bars. So it's broken below 10,250 and it's broken below the inside bars. And you can see how quickly the price is moving down now. The reason that it's moving quickly down is because the two previous bars were bull bars. Although they were inside bars, they were bull bars. And therefore there'll be a lot of traders who thought that the price was going to go up. There'll be a lot of traders who would have thought, well, okay, there's a good chance that this will break out higher since it's now above 10,250. And those traders will have placed their protective stops below that very small range of 3 bars. They'll place their stop below there, and therefore when price goes below that particular level, it wipes out their stops and therefore forces them to sell. And when lots of people sell at the same time, then price goes down. So in that circumstance, you've got two people who are selling, two types of people who are selling. You've got the people who've placed their orders to sell below these inside bars, and you've got people who have got their protective stops down there. So protective stops are effectively sell orders, and you've got people selling down there already. So two lots of people selling, nobody buying, prices are going to go down. And let's see how far they go down. So we're getting near the low of the range again at this point in time. So remember, what we're looking for is we're looking for hesitation. We're looking for small bars. They could be inside bars. They don't necessarily have to be inside bars. They may be bars with a wick on the downside. They may be bull or they may be bear bars. Ideally, we'd be looking for a bull inside bar or a bull pin bar, with the pin being on the bottom. We've had a doji bar at the bottom, so that's a trading range. It indicates hesitation. So we'll see what happens next. And we've had an inside bar there, so we've got an inside bar. It's a bearish inside bar at this point in time. Let's see what happens next. Now we've had a bullish inside bar, so what we're looking for now is price to break the high of that particular bar, and when it does, you'll see the same thing happen again. You'll see people will be entering their buy orders, and you'll see people who've bet that the market will go down further exiting their shorts, covering their shorts. And when you buy back your shorts, it's like placing a new buy order. So you'll have people buying and people covering their shorts, two groups doing the same thing, nobody selling, and there you go. You see prices rising now above those two inside bars, and it should rise quite steeply. May even go back to the top of the range or to 10,250. So it's risen above 10,250 now, and we'll be looking to see at this point in time whether or not price breaks out above the previous high. So that was just above 10,260, so we'll wait and see what happens with this particular candle. So if we'd have actually bought above those two inside bars on the way up, we'd have had a nice trade. And so we're looking for rejection. 10,260, we're there, and we're looking for rejection or acceptance at this particular level. And first of all, what we're likely to get is some sort of hesitation. So if we get hesitation and it starts rejecting at that level, then we'd actually come out of our trade at that point in time. Near the top of the range. Gotta be realistic. There will be some people, they see the green on this bar. There'll be people, there you go, looking for the breakout above 10,260. Looking for the breakout. When price is in a trading range, it rejects the breakouts. It is much less likely to break out than it is to stay within that particular trading range. Obviously, it does break out at some point in time, but it's much less likely to do it than it is to stay within the range itself. In this particular occasion, on this particular occurrence, you can see that price has risen right up from the bottom of the range, near the bottom of the range to the top of the range, very, very quickly. And when it does that, it makes a breakout less likely. When price breaks out, there's a lot of price action around the top or the bottom of a range. If it breaks out at the bottom, there's a lot of price action. You see bars sitting next to each other, you see indecision bars, you see a lot of trading taking place within a very tight range at the top or the bottom of a particular range before price breaks out. On this occasion, it's gone straight up, so it will be quite surprising to see it zoom out of the top of this range at this point in time. So again, We're looking for small bars at the top of the range. When we see small bars at the top of the range, then we can get interested. We've seen a couple of indecision bars at the top there. They're nearly doji bars, where price has closed around about where it's opened. The first one was a bullish bar. The second one's now been a bearish bar. That is pretty much a doji bar. Shows indecision, shows a trading range just for that particular minute. Price fluctuating within that range and then closing near the middle. Very, very slightly bearish, and it now looks as though it's being followed by a bearish bar. So at this point in time, again, you'd be thinking perhaps price has rejected the top of the range. We've had a couple of small bars, nearly inside bars, and there'll be lots of traders betting on price staying in the range and going down again at this point in time. First bar complete now of the move, potentially back down. It's a bearish bar, looking good for the bears. And price falling again now. Okay, so let's just take a little step back from the immediate price action and look at the chart again now, so just to see what it tells us as price plummets down below 10,250 again. So what it actually tells us is that price is still within the same range. We can get a bit more specific now because the range is actually a little bit smaller than we had originally seen, and also the more recent price action actually shows that it slants up slightly and it's possibly a wedge. Okay, so what we've actually got here is we've got two peaks that we can draw a line across, and we've got two troughs that we can draw a line across as well. Experienced traders will all have those lines drawn onto their charts. It's very, very unlikely that price will actually stay within this range for the whole trading day. Might do. We're in August at the moment, so it's quite a quiet trading period. And at some point in time, it's likely to break out. Now, when price does break out, when it's in a wedge, when it's within a wedge, or when it's within a triangle shape, so you judge a wedge or a triangle by the boundaries of the range. When it's in that type of formation, then what you're looking for is you're looking for price to be rejected somewhere in the middle of the range. Okay, so as you can see so far, price has actually fallen down to near the middle of the range, and if it was now to go right back up to the top of the range, then it could be that you're going to see a tight bit of trading at the top of the range and maybe a breakout higher. Or alternatively, price might just be that price has reacted to the 10,250 level and is going lower. Either way, people who have gone short at the top of this particular range will be keeping a close eye, as I am doing, on the price action, just to see whether or not the wedge is going to break out. It looks as though it's just reacting to the 10,250 level as it drops below it again now. So everybody who's gone short can breathe a nice sigh of relief. You can see that this bar here was a pin bar, it was a bullish pin bar, at 10,250. However, there's no space at the bottom of the candle compared to the bearish candle next to it. If that spike was below the previous candle, it was poking out below, then there'd be more people interested in a move upwards, but it's just a continuation. You can see that, again, we're looking all the time, we're looking at what kind of lines can we draw here, and you can actually draw a line, a trend line along the top here now of this particular move down, and could draw a parallel line along the bottom as well. Price is always looking to break out of these trend lines, and it's what happens when it does break out of the trend lines that creates the most interest. Does it go back within the trend line, or does it stay outside of it and break out? As you can see, there's definitely more bullish resistance this time on the move down, but it's just price is just fluctuating around the 10,250 area at the moment. You can expect, as I said, plenty of resistance at that area. It's broken down below it again now, so it's stayed within the little micro trend line. We've hardly had any bars so far that have closed on their exact high or their exact low, which is not unusual for the early part of a day's trading. Lots of bulls, lots of bears, both competing strongly at this point in time in the day. And you can see price now dropping down towards the bottom of our trading range. So let's see what happens when it reaches the lower side of the range, if it gets down there. Interestingly, with this particular pattern that you can see here in front of us at the moment, you can see a definite M shape, which indicates the double top. So the last price rise ended in a second top, and traders use double tops. Lots of traders will see them as major trend reversals, so higher highs and lower highs. So some traders will actually trade double tops from near the top of the second top. So they'll see price dropping, these small bars just on the right hand side of the second top, and they'll have bet on, effectively traded the double top from the top there. And there are other traders who will wait for price to drop below the middle of the double top, and then they'll trade downwards from there. So at this point in time, we're looking to see whether or not it's going to reach that particular level. If it does reach that level, then the chances are that, and it drops below it slightly, then the chances are it will go down. Quite often traders look to measure the trade on a double top from the middle of the two tops, and they measure it with the highest of the highs. So they take they take the measurement from the middle of the tops to the highest top, and they will trade the market down for that particular. measurement. Expect the same move down. So we've had one rejection at the bottom of our range. No particular small bars at this point in time, but that first rejection, it was a bearish bar, but it did have a pin on the end of it. So there has been some rejection so far. So when price is going to break out of a range, you quite often see what is happening at the moment. Doesn't mean to say that it's going to happen on this occasion. But this would be what you'd be looking for. You'd be looking for a series of opposite bars at the bottom of or the top of a range. Red, green, red, green. And it looks now as though it's moving back up to the top of the range again. So some traders might already have traded long here up to 10,260. No small bars, no inside bars down there. We did, however, get a bullish bar closing on its high, which was a good sign for the bulls. Back at 10,250 and and ahhing around about that level. You'd expect it to go through that level and go upwards. The reason that I say that you'd expect it to go through that level and go upwards is because that's what it's been doing. If it was a strong support and resistance level, then you'd have seen price bounce off that particular level, but price has it's paused there and then it's just gone straight through. 1, 2, 3, 4. This is the 5th time it's been around that level. So that's an inside bar. Bearish inside bar, but with the rejection on the bottom side of it. It'll only be noticeable or be of any use if it's an inside bar that's followed by the signal that the market's going to go down and fail in its attempt to get to the top of the wedge. There won't be many traders trading it because it's in the middle of the range. When you're in a trading range, you buy low, sell high. You don't buy or sell in the middle of the range. And moving now above 10,250 again. The reason that you don't buy or sell in the middle of the range is because there's an equal probability of price going either up or down from the middle of a trading range, and there isn't that much room to trade. So the risk and reward on a trade from the middle of the trading range doesn't work out. It doesn't give you a good trader's equation very often, unless the range is very, very wide. So almost the best that you can get is 1-to-1 reward to risk. And if the market's at 50-50, whether it goes up or down, and your reward to risk is 1-to-1, then there's no profit. You'd be looking, with a probability of 50-50, you'd be looking at wanting to achieve at least 2-to-1 reward to risk. And that's why buying at the bottom and selling at the top makes sense, because these small bars at the top of the range and the bottom of the range, small bars means small risk. Traders place their protective stops on the other side of these small bars. So if price goes against them, the risk is small, and they've got the whole of the range to aim at for their target. So they can very often, certainly with these particular trades here, you're looking at 4-to-1, 5-to-1 reward to risk, even when you take into consideration broker fees and charges. Quite a large bearish bar there at 840. Almost matching the previous bar, which was a big bull bar, big green bull bar. And it could be, because it's near the top of the range, it could be that that is another pipe pattern, in this case a pipe top. So at 802 and 803 we had a pipe bottom. That might well be a pipe top. And yep, you can see price now below 10,250 again. Let's have a look and see whether that pipe top was worth trading. So the bars are 10 points long. You'd need to put your stop on top of that bar, by a point or so on top of that bar. Some traders would place their stop above the high of these three tops, so above 10,260, and you'd be entering on the low of the bar or below the low of the bar. So you'd be looking at a risk of something like 12-13 points. You'd be getting in about 10,247, something like that, and the low of this range is 10,235 ish. So 1-to-1 reward to risk with a high probability candlestick pattern to back it up might just be worth it. Okay, so what you can see here is that that pipe top also completed a head and shoulders top. You can see that the middle top is higher than the left shoulder. It's also higher than the right shoulder, which is completed by the pipe top. So again, traders on this, you can see a big strong move down from there, because there will be lots of traders who will be trading now the head and shoulders top and will already have placed trades to go short. The thing here is that that will rely upon a break of the low of the range, which is where we're at now. And there'll be a lot of traders just waiting to see whether it breaks below this low now and breaks out, because that would, with a head and shoulders top, most traders place trades to go short below the neckline. You can see quite a lot of orders going through there. There's rejection at the bottom of the range though. See whether the range holds or whether it goes. You can see the run down has been 4-5 now completed bearish bars, finishing below the midpoint. Shows strong bearish sentiment, and it's now broken below the range. And this is what happens with trading ranges. It may well break out below, however, it'd be unusual because there's no real resistance at the bottom of the range. You'd normally see lots of tight trading at the bottom of a range. Red bar, green bar, red bar, green bar, something like that, and then it breaks out. So it's now broken out of the range, and I would imagine that is because there are people who have traded the head and shoulders top and they'll be looking for a measured move down from the neckline. So measure the move from the last top to where the neckline meets the move down, and a measured move from there, just double it and you get your measured move. And it looks to me as though that might have just completed. So we've got a very, very sharp trend here. You can draw a line down that bearish trend. That's a bearish trend line. So you'll be looking for price to see when price actually pokes above that particular line. But lots of traders waiting to see what happens here, and we've just had a bull indecision bar, almost a doji, right at the bottom. Okay, so there will be people who will be now entering orders to trade up from there, assuming that the market is still in a trading range. So there are two things that could happen here if the market does go up. It could go up to our previous, what was our support line, the lower the range. It could go up to there, and it could test that particular line and see whether it offers resistance, so whether there are sellers above ready to take the market lower, or that line might not offer any resistance and the prices might just go back straight into the trading range. So this is a breakout pullback. Big long tail on that doji at the bottom there. Shows a lot of rejection below 10,220. And the next bar tried to go down and failed at the same level. When the market tries to do something twice and fails, it very often does the opposite. So we'll see whether that theory actually proves to be right on this occasion. That's the same theory that when you get a double top, tries to go up twice, and when it rejects twice at the top, does the same thing twice. Once it fails in doing that, then it tries to do something else, so it goes down. Same with double bottoms. Some people will of course have seen the 820 move upwards as being a double bottom. So they'll have traded it as a double bottom with the 8 o'clock candle, 8:03 and 4 candles. So there'll be lots of traders looking at the slightly higher low and trading it as a double bottom. So when price broke out above the two inside bars, they'll trade long. So we're just seeing the market pausing at the breakout level. We've had a bearish bar and a bearish inside bar. However, the bull bar was closed on exactly on its high, which shows quite a lot of buying pressure at the bottom of the range as we are here now. When you get a lot of buying at the bottom of a move down, there are two possible reasons for that. It could be that there are traders looking for the move back up, And it could also be, bearing in mind that we had 1, 2, 3, 4, 5, 6 bearish bars, it could be that those bears are all just getting out of their shorts at that point in time. And as I say, in order to get out of your short, you need to buy. So that can mean that it's people just buying back their shorts, forcing the market up slightly. And that, in this case, that's probably what it was. So we've had a bearish pin bar near the bottom, 10-2-20. When you start seeing rejection, rejection, rejection like that, pins at the bottom of a range, it can indicate that prices are going to reject that level and go up. So indecision bar, doji, almost perfect doji at the bottom. We'll see whether prices break out. There is a lot of pressure building up at the bottom here. However, it's not quite a tight enough series of bars for me. It went up to nearly 10-2-30 from 10-2-20 and then back down again. Not quite tight enough for me. You tend to see them side by side. Bear bull, bear bull, bear bull, indecision, less indecision, more indecision, less and you see that, and then it breaks out. In this case, 10 points between the high and the low of this particular small range. Probably not enough pressure to break out. More likely that prices are going to enter back into the trading range at this point in time. You can see now that the last bar was nearly a doji again, almost a pin bar, lots of rejection down the bottom, quite a long bar and a bullish bar at that. So you should see prices push up from here and maybe push right back up to the top of the range again. So you got your signal again, you got a pin at the bottom, you got a doji, an inside bar. People will have bought both of those bars at the top of, and the close and the top of both of those bars. And a big long bullish trend bar right back to our previous trend line, the bottom of the trend line. Can expect to see it pause here for a little while. So that's that particular trend line breakout reversed. You can see at the bottom again, a double bottom. And people traded that because price shot up. When price went above the middle dip of the double bottom, price shot up. So again, the measure is from the lowest low. Some people take it from the latest low, but let's say the lowest low to the top of the middle of the double bottom, measure that upwards, and people got their target. These type of patterns probably have a probability of more than 50-50, which is why people are prepared to accept a 1-to-1 risk or reward to risk. So they'll have placed their stops at below the bottom of the double bottom, and the target will have been a 1-to-1 reward to risk. This is why chart patterns are popular amongst traders, because the typical archetypal, if you like, chart patterns do have good reward to risk ratios, and therefore they fit with a good trader's equation. Also, lots of traders see them, lots of traders look out for them. There are normally several double tops and double bottoms every day. and people trade them for a living. So price is pushing back up to 10,250. Of course, we'll be on the lookout for pin bars here. We'll be looking out for dojis. We'll be looking out for inside bars. If we see an inside bar and then it breaks lower on a trend line, on a support line, on a resistance line, or just above or just below, then we're going to be interested. So what you've got for a trade is you've got a signal bar and you've got an entry bar. So a signal bar is only any use when the context is good, and the context is good when it's at support or it's at resistance or it's on the edge of a trend line or just breaking out of a trend line. That's when traders get interested. So that's the context. And so when you get a good looking signal bar, when it's a doji or it's a pin bar and it's in the favor, in the direction of your potential trend, then you look for the open of the next bar to see whether or not it triggers the trade. So if the next bar goes in your intended direction, then you'll be entered into a trade. So people look for these inside bars and pin bars and doji bars. They look for them to form, and just as they're about to finish, just as the bar's about to close, they place a double order. They place an order to either to buy or to sell, to enter the trade, and an order to exit on a stop. So they place their protective stop at the same time. And some also place a limit order to exit their trade. So assuming the trade reaches the target, they will place a limit order to exit there. So you'd then have an order to enter the trade when the candle forms and moves in the direction you anticipate. You've got an order to exit on a protective stop for a losing trade, and you've got an order to exit for a profit on your target. So you can already work out within that order, or those three orders, you can actually work out what your trader's equation is before you actually enter the trade. And if the next candle does exactly what you anticipate it's going to do, then you'll be taken into that particular trade. And at that stage, things are set. And you can, of course, interrupt them at any point in time. However, with your reward and your risk looking good, you've already worked out the trade based on probability, and the trader's equation is looking good. So most traders will then just sit back and see what happens. Wait for them to either be stopped out or for them to hopefully hit their target and make money. So if prices were to fall from here, and they were to fall, then that would mean that the previous breakout had been accepted. The breakout pullback failed, and prices would probably drop. So that's around about an hour's worth of action. I hope you found that interesting. We've seen lots of different candlestick patterns. Hope I've used them as good examples. You've got an idea of buying and of selling pressure through observing candlesticks. We've had a look at a couple of reversal candlesticks. We've also seen some chart patterns within there as well. A wedge, some support and resistance, some trend lines, some double tops, and a head and shoulders pattern as well. So lots of stuff all within 1 hour on the 1 minute time frame on the DAX. And so I hope, as I say, that you found that useful. My name's Anthony Beardsall, and I'll catch you again next time.